Good afternoon, everybody. Happy Monday afternoon to you, unless, of course, you are an equity trader or an oil trader and you happen to be on the wrong side of these plummeting markets. I have no intention, don't worry, I have no intention. I'm a goofball, okay? I'm here about comedy, fun, good times, travel. I don't intend to turn this channel into some type of economics channel or trading or investing channel. I can assure you that. I have the Rosie Murphy channel for that. And if you haven't seen it, I put up a video today called Panic in the Presidency, which gives a little bit of a historical perspective on the political fallout that often comes from major market moves, particularly collapses. Presidents are great at grabbing the glory when things go well. Are they equally good at having the blame pinned on them when things go bad? Well, history teaches that. I hope you'll check that out and subscribe to the Rosie Murphy channel. The link will be in the description box down below. I have today, in light of it is after 1 p.m. on the West Coast, after 4 p.m. on the East Coast here. The markets have closed today with a astounding 2,000 point drop on the market. It sounds like a lot in terms, and it is, but it still pales in comparison on percentage terms to some of the granddaddies of all drops in 1929. Now, comparisons are going to be fast coming out in the future, so I thought I would just tear into this a little bit, because I've had a lot of people have been messaging me and writing me because they know I'm interested. I'm no guru. I'm nothing special. But what I do is have a very keen sense of market history and an intimate knowledge of particularly that period from about 1920 until 1950. One of the most interesting, exciting periods in U.S. history, and that particular depth of study and things like financial panics and crashes, and particularly the crash of 1929. We're not going to get into whys and wherefores. The coronavirus, of course, makes a convenient cover, as I call it, for what's going on in the markets. And the thing to bear in mind as we try to figure out how far will this initial, yes, I did say initial panic carry, is comparisons to 1929 in terms of the feeling of out of the blue that things come when things are great. We've heard President Trump talking about how wonderful the economy is, and it is in pretty good shape, but it's also very stressed. We understand today it takes often two breadwinners to maintain any semblance of a standard of living in a middle class. We know wages are pretty stagnant. We have had the benefits of rising equity prices for retirement portfolios, 401ks, things like that, pension plans. Well, we can see how fast things reverse here as we now sit 20% down off the all-time highs. That's a big hit. And it might just be a preview of coming attractions if history is any guide. I'm not one to panic in life, as you guys know. I'm one to remain calm, because in the very longest run, things always seem to work their way out. But getting between here and the long run is quite the proposition. And as the famous economist John Maynard Keynes once said, he was the guy that introduced the whole idea of deficit spending and stimulating economies through government spending. In the long run, we're all dead. Okay, so no sense getting too worked up about things that happen in the world. And certainly a proponent of why they call economics the dismal science, because there's rarely any good news. Well, in 1929, similar today, things seem to come out of the blue. There was a very sustained rise in the 1920s of stock prices. As you know, the Roaring '20s were marked as a decade where speculation came to the fore more and more, but not as much as people claim. I think between 1928 and 1929, the crash, margin accounts only increased by about 50,000 in the United States. Not a huge figure when you consider the millions of people that had already been in the markets. A lot of this speculative excess is very overblown. The problem is people have never gotten this connection that markets look ahead. They do not look at what is happening today. They look into the future, typically 3 to 6 months ahead. But the financial press has to deal with what happened today, and they have to tag something on that. They have to attribute the decline to something that's going on now, and that something is the coronavirus. Okay, and that gets all the headlines and all of the attention. Smart people that are looking ahead, smart people that understand the forecasting power. Yes, sometimes it's wrong. You remember the famous saying that the stock market's forecast 10 of the last 4 recessions. It don't always have a perfect crystal ball. But drops of the magnitude that we're in the midst of right now, on the order of 20%, are sending out very strong signals that something serious, something very serious is going on, and it's worth paying attention to. But right now we are in this period of fog where we can't make sense of what's going on. It could be a bank failure. Banks are under tremendous pressure. As I said on my upload on the Rosie Murphy channel, I would hate to be in banking now because it is so difficult to make money. Now, in the face of a slowing economy, you can imagine trying to push loans down people's throats who, well, they're a little scared and they're a little shell-shocked, and they may be worried about their jobs in the future. It may not be the easiest thing to do. That's why grabbing for housing right now, just because money is cheap, may turn out to be one of the biggest follies since the run-up of the 2000s of the housing market. Okay. Sometimes interest rates go down for a reason, and that reason is not always good. You cannot force people to borrow. You cannot force prices upward when people are scared of their jobs and when they want to start to become thrifty because they've seen, well, their retirement portfolios, 401ks, ravaged. It's a very, very important concept. So we don't know exactly what the market is seeing ahead in 3 to 6 months, but it will become clear. There'll also be, if history's any guide, there'll be plenty of financial chicanery that is exposed in the coming year or so. As, well, cooking the books and corporations that did other things to sort of juice their earnings a little bit will be coming out probably in droves, and whistleblowers will be coming out. There's going to be a lot, for lack of a better term, there's going to be a lot of pissed off people running around. And as I said weeks ago, get ready for part 2, the return, the great Broadway show, Occupy Wall Street's Antifa, all those great things that make life so miserable at times in the United States when people start taking to the streets because, well, the fat cats have done it to us once again. Well, let's drill down on 1929 now, and particularly September, October, and November of 1929. I did a video talking about how crashes they are not a one-day phenomena. They're not a 2-day phenomena. They unfold typically over a period of weeks. The market peaked in 1929 around September 3rd. It didn't hit its initial bottom till November 5th of 1929. That's a pretty good, October, November, about 2 months, about 60 trading days. Had a big rally from November to April. Then the market just turned down steadily and just declined until it lost 90% of its value by July of 1932. But we're in the initial wave down, the initial shock and awe wave down. So how far could it carry? Well, in a market that is similar to 1929 in terms of the confidence that people had, in terms of the long run that took place in the market, you can argue that the maximum point of panic doesn't occur until people give up, and there is no market for stocks in the short run, which means so far we've had a relatively orderly decline with circuit breakers and things like that. It halted the market at 7%, didn't even trade for the first 15 minutes today. It just opened down. we're in a very precarious situation now. Yes, it would be surprised to get some rallies here and there. But if history's any guide and panic is in the order and it's an economic problem on the order of the magnitude of the Great Depression, which we don't know, we can look back and see that initial decline from September 3rd to November 5th, that initial shock and awe took the market down some 48% as a first leg down. That would put us around somewhere around Dow 15,000 or something like that. Not inconceivable considering right now we're about 20% down. So another 20% down. The percentages are getting bigger as the prices go lower. So it's not inconceivable that the next 20% down, it'll be fewer total points, but the losses in percentage terms will be painful coming up here. So we just don't know. But we do know this. Markets don't typically end panics until there's some degree of what they call capitulation, or people throwing in a towel. There's still plenty of people running around now saying this is the greatest buying opportunity in the history of the world. It may very well be. Or we could be on the precipice of another very severe economic period coming up. Time will tell. But as far as historical precedents are concerned, with collapses, we can certainly look to 1929 as a sort of a similar period, where confidence was high, people were feeling good, and, well, out of the blue, seemingly, things seemed to go bad, really bad, in a very, very short period of time. We'll keep an eye on things. We'll keep an eye on things here, of course. I like to enjoy watching the market. I don't have a lot of, I don't have any stake in it, of course. Being an observer and being a watcher doesn't guarantee that you really know what the heck to do when when the time is right or whatever. But it is interesting to look at things from a historical perspective. Anyway, thanks so much for watching. Your comments are most welcome in the description box. And thumbs up are appreciated too. And, well, we'll be back to regular programming before you know it. Thanks, everybody.